Well, January is definitely here in full force here in Boise. It has gotten a little bit chilly. I'm wearing flannel today because of it. Sorry, but it's got to be done. It's just cold. So let's dive in though to the employment report we got last Friday. Let's get some details on what happened. The headlines looked all positive, nice and rosy. 216,000 new jobs were created in the month of December versus a $170,000 estimate. But if you look under the hood, there's a lot to be desired as far as the strength of this report. So let's talk about that. The first thing that could be desired would be less revisions, fewer revisions. There's clearly something wrong with the data gathering or reporting or something, but the revisions with the BLS month after month this past year have been astounding and frustrating. Okay, so October and November combined, they revised that downward by 71,000 jobs. Said, oh, never mind. Those headlines we gave you in November and October is 71,000 fewer jobs. Throughout the year, if you look here on this last column, throughout the year, well, there's only been a couple of times where they've revised the job numbers up. Most of them have been fairly major downward revisions. You add that up, it's about 500,000 jobs that never really existed, that they, promoted, that resisted, that existed or that were gained throughout the year. 500,000, that's 40,000 a month roughly, that really didn't exist. Now, the reason this is frustrating is because the markets react to the headline. So the bond market, stock market, they react to the headline, especially immediately. Now they might digest it a little bit, for a few hours later, but they're not going to, and then revise right where the market is heading that same day. But they're not going to go back and revise the market sentiment and direction of stocks and bonds from data from 2 months ago or 3 months ago. And so this is the government's been doing routinely, is revising this data and making the job numbers weaker when they get new data or new reporting mechanisms or whatever it is they're doing over there. And so throughout this past year, there's actually 500,000 fewer jobs than were initially reported on the headlines. Frustrating point number one. Let's go to number two. Moving on here. So the BLS survey has two components, the business survey and the household survey. The business survey is what gives us the job number, creation number, and the household survey is what gives us the unemployment rate. Okay, so as we look at the household survey here, actually this is kind of more part of the business survey, actually, is what we're talking about here. They're saying that average hourly and weekly earnings went up slightly year over year and month over month. Okay. The ADP report that measures 10 million workers across the country is more of a private report, comes out a day before the BLS report every month. That had the exact opposite. So they're like going the opposite directions. That one's saying that average hours are decreasing. Our hourly wages are decreasing. Now, the one thing that this did, though, is showed that the average weekly hours went from 34.4 to 34.3 average weekly hours worked. That's equivalent to a loss of 30 minutes, okay, in work time. Now, that's equivalent to about 2 million lost jobs over time since 2020. So do we have a strong economy right now? Yeah, I don't know. Take it for what it's worth. Now, these numbers, by the way, do include the UAW, United Auto Workers strike, the pay increases that they were able to negotiate last summer. So this already includes that. We're still getting fewer weekly hours worked. It does include some of those weekly earnings from the UAW strike. Okay, so next slide. Households. Let's switch to the household survey now. So this is where we get the unemployment rate. Jobs lost, 683,000 jobs lost on the household survey side, and 676,000 people no longer in the labor force, no longer participating in trying to find a job or working. So participation rate actually dropped pretty dramatically from 62.8% to 62.5%. That's a pretty big deal. That's that underscores some underlying weakness there. So if you go to the exact numbers and you do a little math here with the numerator denominator situation and divide them, you have unemployed 6,268,000 people unemployed with a labor force in the United States of about 167.5 million. That gives you your unemployment rate of 3.74%, 3.7% rounded down. Now, what if we added back in those 676,000 people that are no longer participating in the labor force or looking for jobs? Maybe they are looking for jobs. They just took a break. We don't know, right? Let's add them back in there. You add those back into both the numerator and the denominator. And what do you have? 4.13% unemployment. So do we really have unemployment in the threes, or do we have an unemployment rate in the fours in reality? Begs big question, right? Who knows? We're not exactly sure. So we'll find out as months progress here and we don't have these seasonal adjustments and seasonal working hours from the holidays as well. So let's talk about that. On the household survey, Another negative that's really concerning is the multiple job holders are at an all-time high. We had 222,000 people in December add multiple jobs. Okay, so they have 2 or 3 jobs just to make ends meet. That doesn't sound like a very strong labor force to me or economy. Full-time jobs, we lost actually 1.5 million full-time jobs in December, but we gained 762,000 part-time jobs, right? So, okay, part-time jobs, this is probably one of the reasons there are multiple job holders, right? Multiple jobs. People have multiple part-time jobs to make ends meet without the full-time jobs. That, again, does not underscore a very strong, resilient economy. So I expect this data to continue to kind of pile up over the coming months, and the Federal Reserve to be looking at this going, yeah, things are a little weak. We better not raise the rate anymore, and we may want to cut. We'll see what they decide to do. So how's this affected interest rates? 10-year interest rate, the 10-year Treasury, of course, as you know, is a leading indicator of mortgage longer term rates. It's kind of a medium term rate. Since the beginning of the year, unfortunately, we've seen the yield and rate on the 10-year, the yield rise, which is not helpful, except for today. It's kind of come back a little bit. If it stays below this ceiling of resistance at the 200-day and 25-day moving averages, we'll be in good shape, but we're not going to know for sure which direction this market really wants to go until we get the inflation data this week. So on Thursday and Friday, we have inflation reports coming out, the CPI and the PPI. I will do updates on Instagram on that information as it comes out. So if you'd like information sooner than waiting for every Monday video from me, follow me on Instagram. That's the Bill Zimmerman. That's where you can find me, and I'll give updates as we do that. Mortgage-backed securities, of course, are the actual bond that affects and drives interest rates directly for mortgages. And this is the opposite of the 10-year Treasury. When price goes up, that means the rate is coming down. So we've seen price drop since the beginning of the year a little bit, although we've got a little bit of a rebound today. We're staying above this floor of support, the 25-day moving average and this Fibonacci level. Hopefully we continue that and turn this trajectory back around to continuing to go with lower interest rates, because we've seen interest rates rise just slightly since the beginning of the year. So hopefully we get some lower inflation data, some weaker inflation data later this week, which will continue to encourage the Federal Reserve to not raise rates, but to maybe even drop them sooner than later, and at least keep things at the status quo for the near term. So that's where we're at for today. Have a wonderful week.